One thing that has always bothered me about the way people build wealth is that they often treat investing as if it is a game of prediction, when in reality it is much more often a game of sequence. They ask which stock to buy, which ETF is best, whether crypto is going to rise, whether the market is too expensive, whether now is the right time to get in. Those can be useful questions later. But they are often the wrong first questions. If you are putting money into the stock market while a credit card balance is charging you 22% interest, you are not really investing. You are trying to fill a bucket while there is a large hole in the bottom of it. You may feel active, you may feel responsible, you may feel like you are participating in the wealth machine, but the system is working against you because the liability is compounding faster than the asset is likely to compound. That is why order matters. In investing, as in life, doing the right thing in the wrong order can produce the wrong result. A good decision taken at the wrong time can become a bad decision. A strong investment made on top of a weak foundation can become a forced sale. A smart strategy executed before you remove obvious risks can become a very expensive lesson. So the question is not simply where should I invest my money? The better question is, in what order should I put each dollar to work so that every next dollar strengthens the whole system instead of making it more fragile? That is how I think about money. I do not think about it as a collection of random products. I think about it as a machine. Every part affects every other part. If one part is weak, the entire machine can fail under stress. Most people do not think this way. They throw money at the market the way someone feeds coins into a slot machine. They look for excitement. They look for quick movement. They want the next hot idea. And while they are doing that, they ignore the boring things that actually determine whether they will become financially independent or stay financially fragile. They ignore the emergency fund. They ignore high interest debt. They ignore the employer match. They ignore the tax system. They ignore fees. They ignore the order of operations. And then they wonder why they work for decades and still feel like they are behind. That is not bad luck, that is bad sequencing. Recent data shows that 1 in 3 Americans does not even have an emergency fund. The median amount saved for emergencies is about $500. $500 is less than many people's monthly car payment, and it is down from $600 just a year before. At the same time, many of those same people are asking whether they should buy individual stocks, put money into cryptocurrency, or try to pick the next big thing. That is like asking whether you should buy a Ferrari when you cannot repair the transmission on the car you already own. It does not mean ambition is bad. It means the foundation is not ready to carry the ambition. When I study successful people, I do not find that they all predicted the future perfectly. They did not. Nobody does. What I find is that they built systems that allowed them to survive mistakes, shocks, delays, recessions, job losses, medical bills, and emotional pressure. They did not eliminate risk. They built in resilience. And resilience begins before the first dollar goes into the market. It begins with liquidity. Before you invest a single additional dollar into anything exciting, you need an emergency fund. I know that sounds boring. I also know that boring things are often what keep you from being destroyed. An emergency fund is not just a small pile of cash for unexpected expenses. It is a shock absorber. It is a psychological defense system. It is the thing that prevents a small problem from becoming a financial crisis. When your car breaks down, the emergency fund keeps you from putting the repair on a credit card. When a medical bill appears, the emergency fund keeps you from selling investments during a bad market. When your income gets interrupted, the emergency fund gives you time to make good decisions instead of desperate ones. That is the real value. Liquidity gives you control over time. And time is what protects you from selling good assets at bad prices. People often ask how large the emergency fund should be. The standard answer is 3 to 6 months of living expenses. That answer is not wrong, but it is too broad to be useful without context. If you have a stable job with strong benefits and low monthly obligations, 3 months may be enough. If you are self-employed in a volatile industry supporting dependents or carrying a regular income risk, 6 months may be more appropriate. If your life has more uncertainty than average, you may need more. The right answer depends on the risk of your personal system. A government employee with predictable income has one kind of risk. A freelancer with no safety net has another. A person with a mortgage, children, medical needs, and unstable income needs a larger cushion than a person with low fixed expenses and stable pay. This is not emotional. It is structural. But you do not need to solve the entire problem in one leap. Start with the first $1,000 as quickly as possible. That first $1,000 will not make you wealthy, but it can prevent many small emergencies from becoming debt. Then move toward 1 month of living expenses, then build toward 3 months, then decide, based on your own employment and family risk, Whether you need to keep going towards 6 months or more, breaking the goal into stages matters because a huge target can paralyze people. A staged target creates momentum. There is also a psychological reason this matters. Vanguard research found that people with at least $2,000 in emergency savings had financial well-being, scores that were 21% higher than people with no emergency fund. That was the largest boost linked to any financial factor measured. That is important because financial behavior is not just math. It is math plus psychology. A person who feels constantly unsafe will often make bad money decisions even when they know better. A person with a buffer can think more clearly. That is why the emergency fund comes first. It is not because cash is the highest returning asset. It is because a small amount of cash in the right place prevents you from being forced to liquidate higher, returning assets at exactly the wrong moment. Once that foundation exists, the next issue is high interest debt. This is where many people make the most expensive mistake. They invest while carrying debt that is mathematically attacking them. If a credit card is charging you 22% interest, paying it off is not just debt reduction. It is a guaranteed 22% return. And guaranteed 22% returns are extremely rare. If you could find an investment that safely and legally paid you 22% with no risk, every large institution in the world would be lined up to buy it. But people often ignore that return when it is hidden inside their own balance sheet. That is why high-interest debt must be treated as a financial emergency. As a general rule, any debt charging more than about 8% annually deserves serious attention before additional investing. The exact threshold can change depending on the market environment, but the principle is simple. The higher and more certain the interest cost, the more urgent it is to eliminate it. Credit card debt is the clearest example because the interest rates are often above 20%. At those levels, the debt grows faster than most reasonable investment expectations. If you carry $5,000 in credit card debt at 22% and only make minimum payments, you can pay nearly $2,800 in interest over 5 years. That money does not build anything for you. It does not buy freedom. It does not become an asset. It is simply transferred from your future to the lender. So the correct system is straightforward. List your debts, write down the balances, interest rates, and minimum payments. Pay the minimums on everything to stay current, then direct every extra dollar toward the debt with the highest interest rate. That is the debt avalanche method. It is not always emotionally satisfying at first, because the highest rate debt may not be the smallest balance. But mathematically, it saves the most money. Some people prefer the debt snowball method where they pay off the smallest balances first to create psychological momentum. I understand why that works for some people. Human beings are not spreadsheets, but if your goal is to minimize interest and strengthen the system as efficiently as possible, the avalanche is usually the better tool. The key is to stop pretending that investing in high-interest debt are separate decisions. They are part of the same machine when your asset side earns less than your liability side costs. The machine is leaking. You must plug the leak before trying to increase the water pressure. There is one major exception to this rule, and it is important. If your employer offers a retirement match, you usually want to contribute enough to get the full match even before you have completely eliminated high-interest debt. That may seem inconsistent, but it is not. The reason is that the employer match can be an immediate guaranteed return that is often higher than any debt cost. If your employer matches your contributions, they are giving you money for taking action. In many cases, this can be a 50% or 100% immediate return on the dollars you contribute up to the match limit. If you earn $50,000 a year and your employer matches 50 cents on the dollar up to 6% of your salary, you might contribute $3,000 and receive $1,500 from your employer. That is a 50% immediate return before the investments themselves do anything. No ordinary investment reliably offers that. The principle here is not that retirement accounts always come before debt. The principle is that guaranteed returns should be ranked rationally. A 22% debt payoff is powerful. A 50% or 100% employer match is even more powerful. So the right move is often to contribute just enough to capture the full match, then redirect extra money back to high-interest debt until it is gone. There is a caveat. Some employer matches have vesting schedules. That means you may need to stay at the company for a period of time before the match fully belongs to you. You should understand that schedule. But even with vesting rules, the employer match is often too valuable to ignore. Once you have an emergency fund, have captured the employer match, and are attacking or have eliminated high-interest debt, the system begins to look very different. You are no longer building on quicksand. You are building on a foundation. Now you can move into tax optimization. This is the part that many people misunderstand because they go straight to taxable brokerage accounts. They want flexibility, they want to buy stocks, they want to feel like investors. But if you skip tax advantaged accounts, you are often handing money to the government unnecessarily. The tax code creates incentives. Whether you like the tax code or not, it is part of the environment you are operating in. A good investor understands the environment, a bad investor ignores it. After the employer match and high-interest debt, an individual retirement account often becomes the next logical place to put money. The reason is control. With an IRA, you usually have more investment options and often lower fees than you have inside many employer retirement plans. Some corporate 401k plans are excellent, some are not. Many have limited menus of mutual funds, and some of those funds have higher management fees than necessary. Fees matter because they compound in reverse. A 1 or 2% fee may sound small in a single year, but over decades it can remove tens of thousands of dollars from your ending wealth. Low-cost index funds and ETFs can charge only a few basis points. The difference between paying a few basis points and paying 1 or 2% for decades is not a detail. It is a large transfer of wealth. For 2025, the IRA contribution limit is $7,000 or $8,000. If you are 50 or older, that is not enough by itself to build a complete retirement plan for many people. But it is a powerful building block because it gives you tax advantages and control over investment selection. Then comes the question that confuses many people. Traditional or Roth, do you want the tax benefit now or later? Traditional accounts give you a deduction today, but withdrawals are taxed in retirement. Roth accounts require you to pay taxes now, but qualified withdrawals in retirement are tax-free. The simple framework is this. If you are in a high tax bracket today and expect to be in a lower tax bracket in retirement, a traditional account may be more attractive. If you are in a low tax bracket today and expect to be in a higher tax bracket later, a Roth account may be more attractive. Young people early in their careers often lean toward Roth because they may be in their lowest earning years. High earners near peak income may lean toward traditional because the current deduction may be more valuable. But the future is uncertain. Future tax rates are not fully knowable. Your future income is not fully knowable. Your future spending is not fully knowable. So if you are uncertain, splitting contributions between traditional and Roth can create tax diversification that gives you options later. And options have value. Then there is one account that many people ignore, even though it may be one of the most powerful investment vehicles available in the United States. The health savings account, an HSA, is unusual because it can provide 3 separate tax advantages. You can get a tax deduction on contributions. The money can grow tax-free while invested. Withdrawals for qualified medical expenses can also be tax-free. That combination is extremely powerful. It gives you a tax benefit on the way in, during the growth, and on the way out. Few accounts do that. For 2025. The contribution limit is $4,300 for individual coverage and $8,550 for family coverage. The catch is that you must be covered by a high-deductible health plan to be eligible. That is not right for everyone. If you have significant medical expenses, a high-deductible plan may not make sense. If you are young, healthy, and able to handle the deductible risk, an HSA can be an extraordinary tool. The most powerful HSA strategy is often not to spend the HSA money immediately. If you can afford to pay current medical expenses out of pocket, you can keep the HSA invested and allow it to compound. You keep the receipts. There is no time limit on when you can reimburse yourself for qualified medical expenses. That means a doctor visit paid today could potentially be reimbursed years later from the HSA tax-free. If you kept the documentation, this is a rare kind of flexibility after age 65. The HSA becomes even more flexible. You can withdraw money for non-medical purposes and pay income tax, similar to a traditional IRA, but medical expenses in retirement are highly likely, so having tax-free money dedicated to that risk can be a powerful defense. The math can become very large over time if someone maxes HSA contributions for 30 years and earns a 7% annual return. The account could grow to more than $400,000. The average couple retiring today may spend more than $300,000 on healthcare across retirement. An HSA can help isolate that risk and keep it from damaging the rest of the retirement portfolio. That is how I think about it, not as a side account, as a targeted reserve for one of retirement's biggest predictable costs. After the IRA and HSA, you return to the employer retirement plan and contribute beyond the match if you can. For 2025, the 401k contribution limit is $23,500 for most people, or $31,000 if you are 50 or older at this stage. The system is becoming powerful between an IRA, an HSA, and a 401k. A person under 50 could potentially shelter more than $35,000 a year from current taxation depending on eligibility and account type. That is serious money. Money that stays invested, money that compounds without annual tax drag, money that is not constantly interrupted by the IRS taking a piece every year. Most people never reach this stage. The average American saves about 6% of income. That often is not enough to get the full employer match, fund an IRA, use an HSA, and max a 401k. So if you are able to work through this sequence, you are already separating yourself from the majority of people. Not because you found a secret stock, because you followed a better order. That is the point. The best systems are usually not dramatic. They are clear, they are repeatable, they reduce unnecessary losses. The emergency fund prevents forced selling. Debt elimination stops guaranteed negative compounding. The employer match captures free money. The IRA gives control and tax advantages. The HSA gives a triple tax advantage for medical costs. The 401k allows large amounts of tax advantage compounding. Each step makes the next step stronger. Then after all of that, you finally arrive at the place most people want to start. The taxable investment account. This is where you can buy individual stocks, index funds, ETFs, options, cryptocurrency, or almost anything your brokerage allows. There are no contribution limits in the same way there are with retirement accounts. There are no retirement withdrawal restrictions. It is flexible, and that flexibility is valuable, but flexibility without discipline can be dangerous. A taxable account is also where many people make their biggest mistakes because the choices feel unlimited. They begin to confuse access with wisdom. They think that because they can buy almost anything, they should. They forget about taxes. They forget about turnover. They forget about dividends and capital gains. They forget that every time they sell for a gain, the government may want a share. That is the tax drag. The drag may not feel large in 1 year, but over decades it can become enormous. If you invest $10,000 a year for 30 years at 7% inside a tax-advantaged account, you could end with about $944,000 in a taxable account. With the same return but taxes on dividends and capital gains along the way, you might end closer to $700,000. That difference is roughly $250,000, not because the investment was different, because the tax container was different. This is why the order matters. Taxable accounts are not bad. They are just not usually the first place to invest when better tax shelters are still available. Once those are maximized, taxable accounts become very useful. They can fund a house down payment before retirement age. They can provide bridge money if you retire early before retirement accounts are easily accessible. They can create liquidity and flexibility. They can also be useful for estate planning because taxable assets may receive a step up in basis when you die, which can eliminate capital gains taxes for heirs under current rules. So a taxable account is not the enemy. It is a tool, but it belongs in the right part of the sequence. If you put it too early, you may pay unnecessary taxes and skip better guarantees. If you put it in the right place, it becomes a flexible extension of an already strong system. So the complete order is not complicated. Build the emergency fund, capture the employer match, eliminate high-interest debt, maximize the IRA. Use the HSA if you are eligible and it fits your health plan. Go back and max the 401k if you can. Then use taxable accounts for flexibility, additional wealth building, early retirement bridges, and long-term optionality. Some people will want to change the order slightly. That is fine if they understand why. A person with very high credit card debt may need to attack that debt aggressively while keeping only a small starter emergency fund. A person with a very unstable job may need a larger emergency fund before taking more investment risk. A person with no employer match will skip that step entirely. A person who cannot access an HSA will move to the next available tool. A person with a terrible 401k plan may emphasize the IRA more strongly before expanding 401k contributions beyond the match. The principle is not mechanical obedience. The principle is to understand the logic of the sequence: liquidity before risk, guaranteed returns before uncertain returns, tax advantages before taxable flexibility, low-cost broad compounding before speculation, optionality after stability. That is a sound system. And sound systems matter more than exciting ideas. Most people underestimate how much damage is done by doing the right things too early. Investing in the market is good, but investing while you are exposed to a small emergency becoming a credit card balance is fragile. Owning taxable investments is good, but owning them while ignoring an employer match is irrational. Buying growth assets can be good, but buying them while high-interest debt compounds against you is often self-defeating. Trying to optimize the last 1% of investment return before fixing the big structural leaks is a mistake. The big leaks matter more. The obvious things matter more, the boring order matters more. That is how wealth is actually built. It is not built by finding one perfect move. It is built by making sure the entire system points in the same direction. Income comes in, emergency risk is covered, bad debt is removed, free money is captured, tax shelters are used, costs are minimized, compounding is allowed to work for long periods of time, and then, only then, you add more flexible and speculative layers if they fit your temperament and goals. This is why I tell people to think in terms of principles rather than products. Products change, interest rates change, tax rules change, markets change, but principles endure. Do not put money at risk that you may need immediately for emergencies. Do not accept a guaranteed negative compounding machine on one side of your balance sheet while hoping for uncertain gains on the other. Do not ignore a guaranteed employer contribution. Do not voluntarily pay more taxes than the system requires. Do not confuse investment freedom with investment wisdom. Do not build the roof before the foundation. If you follow those principles, your exact investments may differ from someone else, but your system will be rational. And that is what matters. Because wealth is not just about returns. It is about staying in the game long enough for returns to matter. If you are forced to sell during a crisis, the market's long-term average return does not help you. If your high-interest debt compounds faster than your portfolio, the market's long-term return does not help you. If your taxes and fees quietly eat the difference, your gross return does not help you. If a medical bill knocks you off course because you had no liquidity, your investment thesis does not help you. You need a system that survives reality. Reality includes emergencies, reality includes taxes, reality includes debt, reality includes fear, reality includes market declines, reality includes mistakes. The right order is how you protect yourself from those realities. That is why I would rather see someone build a simple, disciplined, tax-aware system than chase the most sophisticated strategy before they are ready. Sophistication built on fragility is not wisdom. It is leverage wearing a costume, a well-ordered financial life may look boring from the outside, but it creates freedom on the inside. It reduces pressure. It gives you choices. It lets you think. It prevents small disruptions from becoming life-changing problems. And over time, it allows compounding to do what compounding does best, quietly, relentlessly, and without needing you to predict the next hot thing. So before you ask what to buy, ask what part of the system needs the next dollar most. Does it need more safety? Does it need less debt? Does it need to capture a match? Does it need tax protection? Does it need healthcare reserves? Does it need long-term compounding? Does it need flexible bridge capital? That question will give you better answers than most market forecasts. Most people will not follow this order because it is not exciting. It does not let them feel like geniuses next week. It does not create a story they can brag about. But it does something more important. It works. It puts the odds in your favor. It reduces the avoidable mistakes. It turns money from a source of stress into a structured machine. And if you do it long enough, the machine begins to work harder than you do. That is the point. Not to look smart, not to chase excitement, not to skip the process. The point is to build a system in the right order so that each decision supports the next one. Your future self will not care whether the process felt boring. Your future self will care that the foundation was strong, the debts were gone, the free money was captured, the taxes were minimized, the health risks were planned for, and the investments were allowed to compound. That is the smartest order to invest your money. Not because it is flashy, because it respects how money, risk, taxes, behavior, and time actually work.